So let me ask you something. If I told you that the United States government made a whopping $127 billion in profit off student loans in just 1 decade, would you believe me? Because here's the thing, that's not some conspiracy theory. That actually happened. Between 2007 and 2012, the federal government was projected to make more profit from student loans than ExxonMobil made from oil. Now, I want you to think about that for a second. The same government that's supposed to be helping you afford college was running one of the most profitable lending operations in American history. And the craziest part? Most people have no idea this even happened. My name is Tom, and I spend way too much time thinking about how broken the student loan system actually is. If you're someone who either has student loans, is thinking about taking out student loans, or just can't understand why college debt has become this massive crisis that nobody seems able to fix, hit subscribe and give this video a thumbs up, because what I'm about to show you is going to completely change how you think about the entire system. All right, so here's what most people don't realize. When you think about student loans, you probably imagine them the same way you think about any other kind of debt, right? Like a car loan or a mortgage. Some bank lends you money, they charge you interest to make a profit, and if you can't pay it back, well, that's the bank's problem. They took the risk, they eat the loss. But student loans, they don't work that way. Not even close. See, about 92% of all student loans in America are federal loans, meaning they come directly from the government. And the government has structured these loans in a way that makes them basically impossible to escape. You can't discharge them in bankruptcy. They can garnish your wages without even taking you to court. They can take your tax refunds. They can even take your Social Security checks when you're retired. Now look, I'm not saying the government is evil for lending money to students, but here's where it gets interesting. The government isn't just lending this money, they were actively making a profit off it, a massive profit. Let me show you how this happened. Back in 2010, something huge changed in the student loan system, and almost nobody noticed. Before 2010, most federal student loans were actually handled by private banks. The government would guarantee the loans, which meant if you defaulted, the bank didn't lose money because the government would cover it. Sweet deal for the banks, right? They made all the profit with basically zero risk. But in 2010, Congress passed the Student Aid and Fiscal Responsibility Act. Sounds boring, I know, but this law eliminated the middleman. Now, all federal student loans would come directly from the Department of Education, no more banks. And on the surface, this seemed like a good thing. The government said, hey, we're cutting out these private banks who were making billions off students. Now that money can go toward helping more students afford college. But here's the thing nobody talks about. When the government took over all these loans, they didn't just break even. They started turning a profit, a big one. According to the Congressional Budget Office, between 2010 and 2020, the federal student loan program was projected to generate $110 billion in profit for the government. And if you go back to 2007 and include the bank-based system, we're talking about $127 billion. Now, you might be thinking, okay, Leo, but isn't that good? The government makes money, they can use it for other programs. Everybody wins. No. Here's why that logic is completely backwards. The entire point of federal student loans is supposed to be helping people afford college. It's supposed to be a public service. But when you structure these loans to generate profit, you're no longer running a public service, you're running a business. And worse, you're running a business where your customers are 18-year-olds who don't understand compound interest and can't escape the debt no matter what happens to them. Let me give you an example of how insane this gets. Let's say you take out $30,000 in federal student loans to get your bachelor's degree. The interest rate on those loans is 6.8%. Now you graduate, you can't find a job right away, and you decide to use income-driven repayment, which caps your monthly payment based on what you earn. Sounds reasonable, right? Here's the problem. When your monthly payment is too low to cover the interest that's accumulating, that interest doesn't just disappear, it capitalizes. That means it gets added to your principal balance, and now you're paying interest on your interest. So 10 years later, you've been making payments this whole time. You've paid back maybe $20,000, but because of capitalized interest, you now owe $45,000. You've paid back 2/3 of what you borrowed, and somehow you owe more than you started with. This is not a hypothetical. This happens to millions of borrowers. And here's where the psychology gets really dark. The government knows this is happening. They have all the data. They know that income-driven repayment plans often lead to negative amortization, where your balance grows instead of shrinks. But they keep offering these plans because it makes the system look more affordable than it actually is. Now look, I need to be fair here. The government would argue that they're not actually making a profit on student loans, and this is where the accounting gets a little tricky. See, the Congressional Budget Office uses something called fair value accounting to calculate the true cost of the student loan program. And when you use fair value accounting, which accounts for the risk of defaults and the time value of money, the student loan program actually loses money, about $200 billion over 10 years. So which is it, profit or loss? Here's the thing. Both can be true depending on how you count. The government uses a different accounting method called Federal Credit Reform Act accounting, which doesn't fully account for market risk. Under that method, the program is profitable, but under fair value accounting, it's not. But here's what matters for you as a borrower. Regardless of which accounting method is correct, the government is still collecting interest from millions of people who are struggling to make payments. The cash is still flowing in. And for a lot of borrowers, it feels like they're trapped in a system designed to extract as much money as possible while making it impossible to escape. Let me show you how this works in practice. In 2021, the Department of Education reported that 43 million Americans had federal student loan debt. The average balance was about $37,000. Now, at a 6.8% interest rate, that's about $2,500 a year in interest alone. Multiply that by 43 million people, and we're talking about $107.5 billion in interest being charged every single year. Now, not everybody pays their full interest, and some people are in deferment or forbearance. But even if you cut that number in half, we're still talking about $50 billion a year in interest payments flowing from borrowers to the government. That's more than the entire budget of the Department of Justice. It's more than NASA's budget. It's more than we spend on food stamps. And here's the kicker. Most of this money is coming from people who can't afford it. According to the Brookings Institution, nearly 40% of borrowers are expected to default on their student loans by 2023. 40%. These are not people who are refusing to pay. These are people who literally cannot pay. They don't have the income. They don't have the jobs. They were sold a promise that a college degree would lead to a stable career, and for millions of them, that promise was a lie. But the government still collects, because unlike every other kind of debt in America, student loans don't go away. Now, you might be thinking, okay, Tom, this all sounds pretty messed up, but how did we get here? How did student loans turn into this government profit machine? Great question. Let me take you back. In 1965, Congress passed the Higher Education Act, which created the first federal student loan program. The goal was simple: make college accessible to everyone, regardless of their family's income. And for a while, it worked pretty well. Loans were small, interest rates were low, and most people could pay them off within a few years of graduating. But then, something changed. Starting in the 1980s, states began cutting funding for public universities. When I say cutting, I mean slashing. Between 1987 and 2012, state funding for higher education dropped by 28% per student, adjusted for inflation. Now, universities still needed money to operate, so they did what any business would do. They raised prices. Tuition started going up and up and up. Between 1980 and 2020, the cost of college increased by over 1,200%, while wages for young workers barely budged. But here's the thing. The government didn't respond by increasing grants or scholarships. They responded by making more loans available. The logic was, if students need more money for college, we'll just lend them more money. And that's exactly what happened. The amount of student debt in America went from $200 billion in 2000 to over $1.7 trillion today. It's the second largest category of consumer debt in America, right behind mortgages. But unlike mortgages, student loans don't come with an asset you can sell. You can't foreclose on a degree. You can't repo someone's education. So what you end up with is this massive pile of debt that's attached to millions of people who have no way to escape it, and a government that's collecting interest on that debt for decades. Here's what really bothers me about this whole system. The government could charge 0% interest on student loans tomorrow. They could do it. It wouldn't cost taxpayers a dime if you use the accounting method that shows the program is already profitable. But they don't. Why? Because student loan interest has become a revenue stream. It's factored into the federal budget. Politicians on both sides count on that money to fund other programs. Changing the system would mean finding that money somewhere else, and nobody wants to do that. So, instead, we get these little Band-Aid solutions, loan forgiveness programs that are so complicated, 99% of applicants get denied. Income-driven repayment plans that extend your loans to 25 years and leave you paying double what you borrowed. Payment pauses that help in the short term but don't fix the underlying problem. And meanwhile, 18-year-olds keep signing up for loans they don't understand, taking on debt they can't afford because they've been told their entire lives that college is the only path to success.